So Peter, welcome. Thank you for joining us today, and I'm going to turn it over to you now.
Okay, thanks for those kind words, Sean, and welcome everyone. Thanks for taking the time to listen to what I think is a very important part of that usually comes about once in a century. The last time we had such a big change would have been the automotive industry using gas, and now we're going to be looking at all things being more and more electric to walk our way to zero carbon. For those that are on the call, and I think we could be numbering up to 90, there's probably some people in the battery metal issuers, the mining side. Those people would be interested in this presentation. Will make it clear that you could issue more flow-throughs easily because we'll be adding what we call a liquidity provider. This is an institution that's going to de-risk these quite volatile shares. So higher premiums, less dilution for the issuers on the call, on the video. For all of us that pay income tax, this structure will work well for your personal income tax. Starts to kick in probably at 150,000 a year. Income works for sure over 220,000. That's in your top marginal bracket. You should be quite interested in this, as well as anyone that plans to give donations. They can be as small as $1,000, could be as big as multi-millions that we deal with, but those donors will be definitely very interested. Those would be the three categories. Of course, wherever there's tax to pay, flow-through shares should be considered. If you've sold a business, sold real estate, or just have regular income tax to pay personally in your holding companies and your operating companies. I'm not expecting, if those aren't accountants on this presentation, we're going to try to make it simple and easy. But for sure, the faster our firm gets to talk to the accountants, that's really where these deals make sense. So let's get right into it. Next slide, please. Flow-through shares. Most of us on the call will know about them. For those that don't, they've been in the code 3 years older than RRSP. So we're about to turn 70 years old. They're very strong politically. We know how great Canada is blessed with natural resources, oil and gas and minerals. We're world class. The problem is the exploration and extraction of them is quite risky. It's venture capital. So the government decided back in the 1954, to give 100% tax deduction. So if your income was, let's say, $300,000 and you bought 100,000 of these junior mining shares, your income would now be $200,000. So definitely significantly more than your RSP. You can buy usually about 40% of your salary. So if an RSP is maxed at 30,000, these at 300,000, you could buy up to 120,000 to give you some ideas. Now, the flow-through share is, it turns into a common share usually 4 months later. Let's say it's ABC Lithium. They issue flow-through shares out of Treasury, so you're not buying them on the stock market. They're coming directly from the company as a great fundraising tool method. They have the great tax deductibility, and then 4 months later, they become liquid and can sell. The problem, of course, is the volatility. These are junior mines. They usually don't have any revenue to speak of. They're just trying to find the revenue in the ground. And if they do have a great discovery, what happens in the pecking order in the mining business is the Barricks, the Techs, the majors of the world will come in and buy them. So that's why the government allows them to have these business expenses. Let's say it's $5 million of drilling expense, and there they can flow through because they don't have any revenue to write these business expenses off. The mining company can flow them through to taxable corporations and individuals. Thus the name. So I think that's enough definition because most of the people on the call know what a flow-through share is. I don't see this tax policy changing. It's very, very positive in many, many forms for Canada. Next slide. Jobs. That's one of the main reasons. Politicians love to get reelected, as we know, and this creates every job is a voter. Not only are we have 700,000 Canadians a year directly and indirectly in the mining business, but it's also the biggest employer of Indigenous. So these are the jobs. They're well-paying jobs, and they're usually in the jobs of the North. For sure, they're not urban city jobs. They're rural jobs. So again, very positive for the government. We're a world leader. a lot of people in Canada, if you're not in the mining business, you don't understand that we're actually 100 billion of our 2 trillion economy. That's 5%. And the reason why most Canadians don't know how important mining is because it's not in your backyard. It's up north where there aren't very many people. To put an analogy, we've also got 7.5% of the GDP is in all types of construction. So condo building, we all see the cranes in our cities. That's right in your face. This is not, but we're almost as big as construction. Another neat analogy I like to state is hockey. We all know how great Canada is on hockey. Now we're at 45% of all hockey players now in the NHL are born in Canada. 65% though of all public mining companies are Canadian. So we are better at mining than we are at hockey. And if you ask your kids or your spouse tonight, I'm sure they'll get that stat wrong. Historically, well, we've got into this business. I've been in the business since 1987. Our focus has been on tax reduction since 1995. We've been doing flow-through shares for my whole career. But in 2006, Stephen Harper finished the job that Paul Martin started as far as a new policy that if you donated public shares, these would be Bell Canada, Royal Bank, as well as mining shares and flow-through shares are public, that if you donate them to your favorite charities, you would not have to pay a capital gain. Well, I immediately knew that flow-through shares are actually all capital gain because the adjusted cost base goes to zero with the 100% write-off. So it just dawned on me, what happens? We have got millions and millions of dollars of these flow-through shares owned by our clientele, and they could make donations. So Earl Winans made a donation to the Heart Institute that was the first in Canada 2 days after the tax law change in 2006. All I've done back in 2006 is I took 2 separate tax policies and I married them together. One, we talked about the flow-through shares. The other policy has been in our code since the tax code started. 1917 is when income tax began in Canada. Prior to that, it was just a stamp tax. You could consider Canada to be a tax shelter country at that point. We're far from being a tax shelter country like the Bahamas or Switzerland with our 54% top marginal rates. But in any event, we've had the charitable credit since 1917. The government really views charitable giving as part of us doing the work with love and attention on those dollars to our favorite charities. The government is all about trying to give this back to whether it's jobs and flow-through shares or whether it's doing the government's work with our charitable giving of universities, hospitals, churches, synagogues, cancer, you name it. There's 82,000 charities in Canada, and the government wants more giving and they want more drilling, which is more jobs. This is a stat about how our firm's done. We're one of 3 competitors in Canada, full-time competitors. So it's a niche of a niche business in Canada. There's Pear Tree, ourselves, of course, Oberon, and Berthoff. So if you haven't heard about this structure, it's because there's probably only 2,000 Canadians that know about it, and they buy it every single year. One of our problems is trying to find enough liquidity providers, which are those are the institutions that we'll talk about a little bit later that take the risk off our structure. This is, of course, a volatile risk structure. They will buy all of our shares at a discounted rate. But as far as numbers, we've done $1 billion in flows. Last year, $55 million in donations. Our clients like to give away that money. They're not sitting. A lot of them use our public foundation, and then that foundation disperses us out to charities of their choice or their own private foundation. 350 million of donations in total in the 16 years. We're well on our way. Critical minerals really became a big story about a year ago, and we're on par now to raise about 150 million this year for more lithium, cobalt, copper, nickel. So all good things, scandium that we need to be able to hit zero carbon. And stat 5, I'm very proud of, 8,000 personal filings, and corporate filings with no CRA issues. We actually have 9 advanced tax rulings from Revenue Canada. We've even had 200 paper audits, which is not many paper audits on 8,000 personal returns and corporate returns. And that's because the government understands they're getting a receipt for your charity component for those that give. You don't have to give to charity, but most of our clients, probably about 98%, give some to charity, and a lot of them give all of it to charity because that's what motivates them most. And then some just keep it for themselves as a pure rate of return. So the key component is the government wants more of this. This is the GIC type of tax reduction when you marry it with a liquidity provider. Next slide. 75% of all junior mining now has been doing what they call charity flow or structured flow. And think of this business now as a 3-legged stool. What the business used to be is there would be a flow through share that was quite volatile. You could double, triple your money, or you could lose 70, 80%, just depending on what happens in the drill bit. And to give you some numbers, 1 out of 10 finds something fairly exciting in the drill bit. That means it's 90% failure rate. 1 in 100 becomes a junior mine, and 1 in 1,000 becomes a Voisey Bay that's going to pay billions of dollars more tax revenue back to the government. But 10 times out of 10, it creates the jobs. What we've done in this 3-legged stool is we've added another component, and that is an Eric Sprott or an AGF Resource Mutual Fund, a Royal Bank Resource Mutual Fund. These are institutional or high net worth people that understand the mining business, and they are able to buy our volatile flow through shares as long as we sell it at a discount. So if the shares are trading at $1, the charity flows or structured flow could be at $1.20. That's the premium because it comes with 100% tax deduction. And then those can be sold at 80 or 70 cents, or so every deal is negotiated to this liquidity provider that will immediately take away all the risk. So we're going to make this into a GIC type of investment for our clients. It will no longer be the home runs or strikeouts. And because of that, we've been able to dominate, going from basically zero exposure in 2006, where all the flows were done with risk, where you bought them and you held your breath. Hopefully you had great success, but many times, majority of times you didn't, to now every time it's a double. Our problem, though, is usually we don't have enough liquidity providers, and that's been the case as we've been in a bear market for about 10 years in mining. But the good news for us this year is the Australians have come forward. They found out how great and how discounted our Canadian critical mineral business and our mining companies are. So they've been in with tens of millions of dollars of additional liquidity providers. Next slide. Here's for our issuers. We've been doing this, as I said, since 2006. We've done 600 closed charity deals. That's more than anybody else. And some positive words from some of our clients. Walter Coles. We started with Skeena when they were at $25 million market cap, and we've probably raised them over $300 million as they've gone and discovered a mine, and they're over $1 billion market cap right now. This is a slide that explains the 3 types of giving. Unfortunately, major gifts, still 80% are write a check. That would save you 50% tax bracket. We're just taking an average. It's 54% in a lot of provinces like Ontario, Atlantic Canada, but some of them are 47%, for example, in Saskatchewan, and a little bit less in Alberta. So let's just take an average tax of 50%. You write a check, 80% of the time, that's what's happening. Unfortunately, Canadians love to complain about how much tax we're paying, but we're not using points 2 and 3. And to be fair, point 2 is always out there. Point 3, sometimes if we don't have liquidity providers or you haven't heard about it until this webinar, that's why you haven't been doing any of your donations in point 3. We want people to do more of 2. And of course, 3 is where we get paid, where we're able to charge a fee by structuring the deal. Point 2, you don't have to pay a capital gains tax when you donate public shares. Remember that law changed in 2006, and Paul Martin had a half capital gain back in 1997. Again, the government wants more donations, not less. That's why they're offering these tax incentives. I've done the math for you. If you don't have to pay a capital gain and your stock doubled, you save 12 cents. It's going to be 38 cents. A 10-bagger, 27 cents. It doesn't get any better than zero adjusted cost base. That would be Mike Lazaridis or Ted Rogers, Lazaridis Foreign Research in Motion. They had zero cost base on their public shares, but they can't get any lower than 25 cents. With our clients, our average, the highest is 25 cents and the lowest is, our favorite is the 1 cent cost. So literally it would cost you $1,000 to give $100,000 because of putting our two tax policies together. The negative on point 3, of course, is you have to write a check, whereas point 2, you already have the shares publicly. We work with many of our clients that have public shares. We're a big believer in donating those, so you don't have to write as big of a check, but then we can take that 38 cents or that 25-cent cost and even grind it down to a penny by doing point 3, which is more tax savings, more tax reduction, but you don't have to give the flows to charity. You can keep them for yourselves and make a profit. And our average profit is a 25% rate of return in the second year. I think that's enough on that slide. Again, this is more details that, of course, people that have good accounting or good at math, they would understand. The same thing with this slide. This is our closing slide. Remember that three-legged stool I was talking about? In the past, it would just be the mining company and the investor, but we've added that third position to de-risk these, and that's that liquidity provider that will buy it all because he really does like ABC lithium, as long as we sell it at a discount. So here's the math. Let's say these shares are trading in the Toronto stock market. We use Faskins to close. They're $1.25. The flows will have a premium. We'll call it $1.50. So a 25-cent premium. You'll write a check, and of course, in the real world, that might be $150,000, but we'll just go work on per share. The $1.50 you purchase, that'll save you 75 cents in tax. Remember the 100% tax deduction? That you'll buy those, so you'll show up at the closing table with your $1.50, being the donor or the investor. You would send that $1.50 up to the mining company, and the mining company, of course, would go up north to drill. Again, in the real world, that might be a $15 million drill program. Now, here's the only risk in our deal. Now, we've talked about there's no stock market risk, because remember, we're going to sell that stock 1 second later to Eric Sprott, who's my biggest and favorite liquidity provider, as well as a bunch of resource-based mutual funds and institutional money. The risk is the mining company, and this is well known, a CFO of the mining company could get fired if this isn't done properly. They have to spend the $1.50 on drilling. That's crystal clear in the tax code. They can't use that $1.50 to pay for salaries or for rent. It has to be around the drill bit. Because it's so black and white, I've been doing this for 36 years. I've done over 1,000 flows, 600 of these structured flows with the liquidity provider, and I've only had to deal with it 17 times out of over 1,000. Now, there is an indemnification. We don't do a deal without the mining company promising to spend the money right, and if they don't, the indemnification kicks in, and they have to pay us back of any CRA reassessment in 20 days. So that's our risk, and it's very well covered. So really, it truly is the GIC of tax reduction. So getting back to point 2, the investor at point 3 then immediately sends those shares down of ABC Lithium to Eric Sprott, who then prearranged, we've negotiated that he'd buy all the shares at $1. He might have wanted to buy the shares at 90 cents. We wanted to be higher. The higher, the better for our clients, which are investors and donors, at $1.10. These are all negotiated, but generally we have to give them a 20 to 30% discount. And then he will buy all the shares and take the risk. Now, he can't sell those shares for 4 months. These are usually private placements, so they're locked up. But his bet is the shares are $1.25, the flows are $1.50, trading liquid in 4 months' time. Chances are they shouldn't pierce through the dollar, although they could. But if he buys a basket of them and he has multiple mining companies, then he gets the diversification. For us, we're happy to be able to walk away with a great rate of return, which is 0.5. We can give that $1 of cash that we received immediately from the liquidity provider to our favorite charities, or keep it for ourselves. Now, if we keep it for ourselves, that gives us $1 in our pocket. And remember, point 1, you get 75 cents of tax savings. So that's $1.75, combining that on $1.50 investment. You just made a 25-cent profit in 1 second, guaranteed. So that's a phenomenal rate. Usually a GIC would only pay you 5%. We're looking at rates of 25%. Now let's switch to the donors. And that's the majority of our clients. And of course, on this call, usually someone has to give some to charity, wants to give some to charity, even if it's only $1,000 or $5,000 or $10,000. You could keep that dollar, you could send that dollar, to your charities of choice. You would get another tax savings. Remember, that's 100% deductible as well. So that saves you 50 cents for the charitable donation, 75 cents is what's coming from the flow-through share. 75 plus 50 is $1.25. You wrote a check for $1.50. That means you only paid 25 cents to make a dollar donation. 25 cents to make a dollar donation. We all know it usually costs you 50 cents. Now, let's put that into perspective on a picture. We've used $1 million tax return. Now, of course, if you made 250,000, just knock these numbers down in quarters, or $500,000 would be half. If you made $1 million after your accountant, she's done everything she can to reduce your taxes. Maybe there's a holding company, an operating company, you've got a family trust. We're the last tax deduction that your accountant can use. We'll come in after all the tax planning is done, and we're going to improve on that 500,000. This is for the donors. Now, the next click will show you 270. This is up to the maximum amount. This is what they call alternate minimum tax. CRA will collect 270 on the philanthropic tax return. The next box will show the cost of buying the mining flow-through shares and selling them at a discount. And this is the most important, the gold and yellow. $100,000 goes to charities of your choice. This is our 1 cent cost shown in a picture. It's exactly the same whether you file the left return or the right return. And in our business, one of those two tax returns has to be filed. So that's pretty well it. A client would say, well, please talk to my accountant. If this works, of course, I'm going to choose the number on the right. And if you made 250,000, you can make about a $25,000 donation at a 1 cent cost. And this is after our fees with the professionals that are involved in the structuring. All these numbers I share with you are after our fees are collected. So let's go on to the old-fashioned way of giving. That would cost you 50 cents. So your tax would drop by 50,000, but you wrote a check for 100,000, which is 80% of all the major gifts still in Canada. It costs you 550,000 to give 100 grand. Versus our way, even after fees, you're saving $50,000. Next slide will show you when you don't want to give to charity. Now, you might say, Pete, look, I can buy 100,000, but I want to give a couple of thousand to charity, and I want the rest for myself to improve and increase my net worth. Again, compare 500,000. If you just file a different return, you can get this experience on the right. 58,000 of green profit. The returns, the costs are the same, but your profit is $58,000. 310 goes to Revenue Canada, 132 goes to drilling. And let me show that most of our clients, and I'm sure on this call as well, like to see that 132,000. That creates the jobs, that creates the critical minerals that we're going to get to zero carbon. So it's a really feel-good period because we all know that, and I live in Ottawa, that where I see that the government isn't as good as we all hope they am at getting the most out of our tax dollars. So this is our way to direct our tax dollars to where we want them to see and do more good. The future, green mining. Well, you can't, you've seen the federal government in 2022 came up with this 30% federal credit. I have to say that was a pleasant surprise. This is on top of the 100% tax deduction and the 15% federal credit that you would give with regular mining. So they've been offering that since 2001, and they took the subsection, not the precious metals, the gold and the silver, and specifically focused on the battery metals that we're talking about here, the people on the screen today. Also, you factor in all the other copper and lithium and all the other 17 critical minerals that receive this 30% federal credit. Next slide. The government is doing everything they can to be able to get us to do more of this. And they use tax as their incentive for us to follow their direction. This is our finance minister, Chrystia Freeland, talking about how blessed Canada is. Us, Australia, we are blessed with these critical minerals. The world wants to buy them from us. Right now, they're buying them from China, and Russia have been dominating the rare earths and the critical minerals. The world, at least the G20, the Europeans, the Americans would want to buy from us and from Australia as much as possible. Even more government support. So that was 2022. And just last month, Manitoba, that had tried a provincial credit 5 years earlier to great success, and it was about to expire at the end of 2023, and they made it permanent. Same thing with Saskatchewan. No, they had a 10% provincial credit. They moved it to 30% credit just last month, when it focused on specifically critical minerals, which would be uranium for them, potash and helium, and they also have some copper. So the point to be taken here is the government is completely behind this structure. This is not a tax loophole. This is not even a tax shelter. These are government policies that the government wants more of us to do. Next slide. You could choose any article in the last year. It could be the London Times, could be the Wall Street Journal. This is from the Globe and Mail. We definitely need 10 times more critical minerals, else we're not going to get to zero carbon. So what's at stake? This is getting back to climate change. Obviously, you can see this poor polar bear. He hasn't had a meal in a long time. Scarcity because of the polar ice cap. So our wildlife's at stake. Our cities are at stake. This is Miami. This is what it could look like at 2050, 2035, with any type of increase in the ocean. Miami would be underwater. So would New York City. So would many of the coastal cities around the world. Food supply. We've got extreme weather, droughts, too much rain, flooding. It's a big, big concern. We've got to get to zero carbon. We've got to cut down our carbon footprint. Wildfires. This is Australia. It happened several years ago. If you remove the kangaroo and the palm tree, that could have been a house in Nova Scotia last week. This is serious, serious problems. And the historic picture last week, New York City, you could barely see the Statue of Liberty. This is because of the Quebec wildfires out of control with winds blowing them south. So how can we help? Well, by you purchasing flow-through shares, you're helping the junior mining companies finding more of these important critical minerals. Point two, you're going to create jobs, support our economy. And point three, you're going to be able to help yourself. You're going to be able to help yourself by decreasing your taxes with both the federal credits. And remember, a credit is twice as good as a deduction. If you get a 30% federal credit, that's like a 60% deduction. And then with the two policies, 100% tax deduction with the flows and 100% tax deduction with the charitable receipt. That's why when you saw those blocks that we showed the tax returns, the numbers were so phenomenally positive. It's because of taking advantage of all these deductions, and we're focusing on taxpayers, if they're in Saskatchewan, Manitoba, BC, or Quebec, focusing on the extra provincial credits that we can match with the provincial tax filers in that province. So what's really happening with structured flow-throughs is we're really getting the most juice out of all these tax deductions. And we've stated it time and time again on this presentation, there is no pathway unless we get more critical minerals. So you're doing good on top of good.